Hey, this is Matt from Let's Not Be Fools, and let's talk about panic selling in the stock market and why you should avoid it at all costs. When you think about it, when you panic and sell your stock position, you're really trying to time the market. You're trying to get out, you're fearful of something, you're trying to get your money out and save it from something, but then again, I think in the back of your mind, at some point you're going to jump back into the market. But really, that's market timing that you're trying to attempt. And although it may work 1 or 2 times in your lifetime, I don't think anybody can really consistently time the market, jump in and out at the optimum points. And I would just say, avoid trying to market time ever, and especially at times when there's panic selling going on. You may recall late last year, there was a market sell-off. There was quite a panic going on, a lot of panic selling going on, but then within a couple of months, you'll see that the market jumped right back. Look at the chart that I'm showing here. You'll see the S&P 500 dipped way down in December and then went right back up again in the early part of 2019. So the point of this video is to encourage you to never sell when there's a market panic going on. When there's panic selling going on, I want you to hold your positions in your stocks or your bonds or your mutual funds, whatever it is. I don't want you to buy into the hype or the fear of a market sell-off. It's just a temporary thing. You're probably only going to end up losing in the long run by selling off your position in a market panic. And there's some data I want to talk to you about here. So a shout out to Charles Schwab Company for releasing this data. It's very interesting, very eye-opening, and that's why I want to share it with you. So what they did was they looked back at the S&P 500 index from 1970 through 2017, so quite a good period. And what they did was they said, okay, what if a person sells out of their market position, let's say their S&P 500 fund, mutual fund or stock or whatever. What if they sell out at the bottom of a market, the bottom of a bear market? What effect would that have on their portfolio? So they looked at 4 scenarios here. One is that at the bottom of a bear market, you remained fully vested. That is, you did not panic, you did not sell out your position. From the bottom of that bear market to 1 year later, your investment portfolio on average gained 46%. 2 years later, it was higher by 70%, and 3 years later, it was higher by 83%. Now contrast that with someone who sold out at the bottom of a bear market and held their money in cash for 1 month and then went back into that S&P 500 fund. The effect of that would be after 1 year, their wealth will have grown 29%. Contrast that with the 46% with the person who just held on through the bear market and never sold out. 2 years later, it was only up by 46%. 3 years later, 57%. Had they held their cash out of the market for 2 months after the market bottom and then went back into the stock market at the S&P 500 level, their returns after 1 year, 20%, 2 years, 41%, 3 years, just 50%. You'll see much lower than if you just held on to your fund through the bear market. And then if they held their cash for 3 months out of the market and then entered in, obviously the returns are lower, 13%, 32%, and just 42%. So I say what this shows us is that it's really of no benefit to try to pull your money out and time the market in a market sell-off just to try to go in later on and get those gains at a safer moment. In the long run, you're probably going to end up shortchanging yourself. So that's an argument right there against panic selling. Panic selling is just trying to time the market, and very few people can time the market consistently. In fact, I don't think anybody can time the market consistently. It's a fool's game. Don't try it. Here's another set of data that I wanted to present to you. Compliments of Tony Robbins. I was watching a YouTube video where they're interviewing him in regards to one of his financial books, and he threw out a study and showed some statistics that were rather enlightening. So he says they did a 20-year study on the S&P 500, and over 20 years, your average annual return was 8.2%. Okay, that sounds reasonable. He said, though, if you missed the top 10 trading days in that 20-year period, in that S&P index, you would have only gained a 4.5% annual return. That's quite a difference. It's almost half. That's crazy, right? Just missing the top 10 trading days. I don't know the veracity of that data. I just have to assume it's true, especially if Tony's saying it. Not necessarily that everything Tony says is true, but I'm sure he wouldn't have said it if there wasn't the backing data. But that's amazing. That's an amazing figure. If you missed the top 20 trading days in that 20-year period, your annual return would have just been 2% per year. That's pretty amazing and kind of scary. And then if you were out of the market on the top 30 trading days in that 20-year period, on the S&P 500, you would have actually ended up losing money over that 20-year period. That data alone right there shows you that you should never try to time the market. By trying to time the market, you may be out of the market on some of these key days that contribute a lot to the total return of the market over that 20-year period in the future, let's say. So again, let's just avoid trying to time the market at all. Let's not buy into the panic selling that goes on. Let's be firm in our resolve just to stay steady with our investments. Have a great day.